Good morning, everyone. This is Marshall Giller bringing you the morning comment for February 10th. The dollar weakened against most of the G10 currencies despite a further rise in the Fed funds rate expectations and deepening concern about the Greek situation and Ukraine tensions. I can only assume that it was caused by profit-taking after the dollar's payroll-induced bounce on Friday, as there wasn't any fundamental news behind the move. We seem to be headed to a showdown over Greece on Wednesday. Greek Prime Minister Tsipras vowed to keep on with the program that his government was elected on, namely allowing the current bailout program to expire on schedule at the end of this month while attempting to secure a new program. The Greek government will seek a bridge agreement until June, but the head of the Eurogroup has already ruled out a bridge loan, so tomorrow's meeting is likely to reject the Greek proposal. In short, tomorrow's meeting is shaping up to be a key pressure point for the markets. Sunday's by-election in France shows why the EU has to settle the Greek problem. French President Hollande's Socialist Party won narrowly, but the real news was that the far-right National Front candidate got nearly 49% of the votes. Incumbent politicians must be terrified about how the austerity programs are fueling support for their opponents on both the left, such as Syriza in Greece, and on the right, such as the National Front in France. They have to prove to voters that the EU is listening to them and responding to them. Otherwise, there will be a revolt. That's why I think they will reach some agreement with Greece, although it's hard to see what the shape that agreement will be at this point. As for today, the G20 meeting ends. According to Bloomberg, a draft of the communique effectively gave the official stamp of approval to the recent indirect currency wars. It said that uneven global economic growth means some nations need easy monetary policies as others move towards normalizing policy, and they welcome the ECB's quantitative easing program. In other words, everyone can continue doing what they're doing. This is bullish for the dollar and negative for the euro, the yen, and almost every other currency, come to think of it. Britain's industrial production for December is forecast to fall on a month-on-month basis. That would be 3 consecutive months of month-on-month decline, suggesting that the economy contracted towards the end of last year. The news could leave sterling vulnerable. In the U.S., only data of secondary importance are coming out. The NFIB small business optimism for January is expected to have increased fractionally, while the job opening and labor turnover survey, the JOLTS report, is forecast to show a marginal increase in the number of job openings. Following last week's strong employment data, these two indicators are likely to keep the dollar supported. For more information, including technical analysis, please read the full comment on IronFX.com. You can also follow us on Twitter, like us on Facebook, subscribe to our YouTube channel, or circle us on Google Plus to get more trading ideas. This is Marshall Giller, head of Global FX Strategy at IronFX Global, wishing you solid trading.